Hey, welcome back to YT Finance, and in this video, we're going to be talking about SoFi Technologies, Palantir Technologies, Tesla stock, and NEO stock. For this video, we will be diving into 5 articles and analyzing them while also giving you the latest price targets and updates for these various companies. The first article is titled, "Is SoFi stock a buy during the dip?" Yes, things are getting better. After that, we'll analyze another article regarding how Palantir has recently been awarded and renewed contract with AUSTRAC, or the Australian Transaction Reports and Analysis Center. And this is going to be huge news for Palantir Technologies, which is why the next author believes that Palantir is set to surge from this point onwards, which is why he is increasing his overall position. But of course, I'll add my own personal comments on that article as well. After that, we'll move on and discuss why Tesla stock is a buy right now regarding their latest news updates, and then we'll round off the video talking about NEO shares and how an upcoming catalyst is on the horizon for March 28th, so investors clearly would need to mark their calendars for that. All in all, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new for more videos just like this one, and without further ado, let's jump right into it. SoFi Technologies is a fintech company or a financial technology company that offers their consumers an all-in-one inclusive digital app which gives them access to various financial services and financial products. SoFi's share price, according to this author, is a buying opportunity, and he actually recently upgraded his rating for SoFi stock from a hold rating to a buy rating. So we'll be discussing their latest news updates and what has caused this particular stock reporter to increase his overall rating. He did this for mainly 3 reasons. The first reason is that they had a limited exposure to Silicon Valley Bank, which recently went out of business, even though depositors will be made whole. Secondly, the author cites that the expiration of the student loan moratorium will cause their overall share price to increase, thus bolstering the overall bullish thesis for SoFi Technologies and their SoFi stock. On top of that, he also supports a buying opportunity because macroeconomic factors are anticipated to improve over the next year, meaning that over the long term, SoFi is anticipated to increase in their overall share price. However, as of late, SoFi's share price has actually decreased by around 25% year to date from their former peak of around $7.72. One of the main reasons for this is due to the volatility in the overall banking sector, which SoFi is a part of, on top of the volatility that is surrounding the Silicon Valley Bank fiasco. SoFi also provided further clarification that their bank's overall exposure to high-risk financial institutions is essentially zero, considering that SoFi has announced that it holds their assets in approximately 30 different financial institutions. So it really doesn't even matter if they had money in the Silicon Valley Bank, because they are diversified in 30 other banks and financial institutions, to where even if 2 or 3 or 5 of these institutions went out of business, it wouldn't really hurt SoFi Technologies because they have their money in a plethora of financial institutions, making them very safe and diversified. So this then begs the question, is SoFi's bank financially sound to withstand this overall volatility in the banking sector? Well, clearly I would say yes, considering that their liquidity on their overall balance sheet says that they are well positioned to withstand macroeconomic storms. They have around $18 billion worth of quote-unquote capacity at their disposal that they could use in dire times if they really needed it. I'd also want to make you aware that SoFi Technologies revealed, according to their fiscal 2022 10-K filing, that they only had around $616 million worth of unsecured deposits. So what does this mean? Essentially, this would make up 10% of their overall deposits are unsecured, meaning that 90% of their overall deposits are secured by the FDIC insurance. And this insurance originally only went up to around $250,000, so the majority of their deposits, even if a bank run were to happen to them, they can easily survive it. On top of that, they've recently increased their overall FDI insurance coverage up to $2 million, thus increasing their total deposit coverage, meaning that this company is extremely resilient to overall bank runs as well as other unconducive financial obstacles that the company could face, meaning that SoFi is one of the strongest banks in the economy right now, especially compared to other banks which are susceptible to a bank run. To put this more in layman's terms, SoFi is not at risk of 1, going out of business, or 2, not being able to pay back their investors. This means that SoFi is not only a safe company to invest into, but also a safe company to hold your personal money in. After the majority of this news has come out over the past few days, SoFi's share price has actually increased by around 10%, meaning that investors are reflecting a very positive reactions to this news regarding how stable and resilient SoFi is. So, is SoFi stock a good buying opportunity even though the share price is dipping due to macroeconomic factors? And the answer, according to this stock author, is yes. Now, I do want to add that you shouldn't over-allocate yourself to any singular risky growth company without A, doing your own research on this company, or B, you shouldn't probably expose more than a 5% allocation to this company, because anything beyond that would mean you are taking on unnecessary risk, and for me personally, I only have around a 4% allocation for this company. Moving right along, let's talk about the latest news updates for Palantir Technologies, which was recently awarded an extension and renewal for their contract with AUSTRAC, which is currently valued at $8.1 million. And like I've said before, Palantir is very good at furthering their existing relationships with partners that they already have contracts with, so it's always good to see that existing partners are either renewing or extending existing contracts for this company. Palantir Technologies, if you didn't know, is a big data and analytics company that serves both commercial enterprises as well as government clients. They are also very involved with artificial intelligence, and it allows an organization's management to make data-driven decisions. Recently, the Australian Transaction Reports and Analysis Centre, also known as AUSTRAC, renewed their partnership with Palantir, meaning that they not only love Palantir Technologies, but they're also willing to do further business with them in the future. Right now, AUSTRAC utilizes Palantir Technologies' Gotham platform and their Foundry platform regarding their software. And a Palantir representative even said, and I quote, "We are proud to continue and expand our partnership with AUSTRAC and remain firmly committed to supporting their mission." He goes on to say, AUSTRAC personnel are using Palantir's software to identify national security threats and to detect and disrupt criminal networks, a real contribution to making Australia safer, end quote. Essentially, Australia is using their technology not only to prevent counterfeiting, so this should reflect very positively in the overall PLTR share price. On top of that, this author is buying more Palantir stock, and we'll discuss why that is right now. Essentially, the main thesis from this article is even if we take the lowest downbeat numbers from very bearish professionals, which are negative critics on this company, the consensus is still relatively positive if and only if you plan to hold this company over the long term. For instance, right now the consensus analyst estimate suggests that Palantir will grow their revenue by around 17% for the year of 2023. However, according to this author, Palantir could beat on these revenue projections and actually bring in revenues between $2.3 and $2.4 billion, which would equate to a 22% to a 25% year-over-year growth rate in regards to their overall revenue. This will reflect very positively in their PLTR share price if they are right, and if they are not right and they just meet expectations, that is also going to be good for the overall company. The author believes that Palantir's growth should improve in future years, especially as the economy bounces back to where Palantir could end up achieving that 30% CAGR growth rate for their revenues like we were promised back in 2021 and 2022. However, where I personally am going to disagree with the author is that this author believes that by 2027, 2028, and 2029, the company would be worth $52, $59, and $70 respectively. However, I think it's a huge leap to jump from $33, which should be their worth in 2026, all the way to $52. This is actually anticipating an increase in their overall price to sales ratio, or their PS multiple, which I just don't see happening. I think these higher end price targets are actually too bullish, and I think we should more gravitate to around the $8.50 price target to the $21 price target over the next 3 years. But I would love to hear where you land and what you think Palantir is actually worth according to their share price. The author does highlight some risks of investing into this company. For instance, if Palantir ever lost one of their 5 main contracts with the government, they would lose a large portion of their overall revenue. Because essentially, Palantir has 5 major contracts with the government, and if they were to lose any of these, their revenues would really be hit hard. On top of that, if Palantir ever had a data breach, the share price would absolutely plummet close to zero. So these are things that you do need to be aware of if you are a PLTR stock investor. And of course, I don't advocate more than a 5% portfolio allocation for this particular company, because beyond that point, it would be improper risk management. Now let's move on and talk about Tesla, which is the United States electric vehicle manufacturer who also specializes in energy storage and energy generation. A lot of people leave that out. Elon Musk, who's the CEO of Tesla, is planning for Tesla to be the largest automotive manufacturer in the entire world by 2030. And many analysts and professionals believe he could do just that. And I honestly think they can do this. Just look at their delivery numbers, which range from 2012 to 2020. This is an exponential growth rate to where Tesla could easily take this position well before 2030, making them one of the best auto manufacturers in the entire world. Tesla had an overall outstanding 2022, and I believe 2023 is going to be even better, because in 2022, the company produced around 1.3 million electric vehicles. To put that into perspective, this is more vehicles than the company made from 2012 all the way to 2020 put together. Clearly, this is an exponential growth rate, meaning that 2023 is going to be even better. On top of that, clearly these production numbers are going to increase to higher sales volumes and boost overall revenues, to where their overall revenue jumped from $53.8 billion in 2021 up to $81.4 billion for 2022, which represents an increase of 51%. But what we really want to talk about is their net income. Their net income grew from $5.5 billion as of 2021 to $12.6 billion in 2022. So even though their revenue only increased by 51%, their overall net income grew by 129%. So how is this possible? Well, essentially, Tesla is using what's known as economies of scale. The more units you produce, the cheaper it is to make those units, and this allows greater margins for the units that you are manufacturing. Essentially, higher output equals greater efficiency and better margins, which reflect very positively in their overall earnings. So is Tesla a buy? According to this author, absolutely. The author also believes that Elon Musk could easily become the #1 car manufacturer in the world by 2030. As of right now, Toyota is actually the world's largest vehicle seller with 9.6 million vehicles sold in 2022, but Tesla is looking to dethrone them, even though Toyota is a phenomenal company, and I suggest investors do their own research and look further into this growth behemoth, especially over the next few years, because that's when Tesla is really going to shine. Lastly, to round out the video, let's talk about NIO, which is a Chinese electric vehicle maker. And if you own this company, you want to mark your calendars for March 28th. I've mentioned this very briefly in a former video, but as that date draws near, we really need to start paying attention because it could act as a catalyst for the overall share price. The new battery swapping station network isn't the only reason to bet on NIO, however, because undoubtedly the company is increasing their overall sales and deliveries. I also want to make investors aware that they are planning to build more battery swapping stations. For instance, they raised their goal from the original 400 swapping stations by the end of 2023 up to producing 1,000. So they almost tripled their overall goal, and that means that they are set to have phenomenal growth. They are also utilizing other markets over in Europe as well as the Chinese market, meaning that the management of this company is anticipating greater revenues and a greater share price in the future. But always make sure to do your own research. For more videos on SoFi, NIO, Tesla, and Palantir, go and annihilate that like button right now. Comment your thoughts down below. Subscribe if you are new, and I will see you in the next YT video.